Hello and welcome to Finance in 5, where viewers gain investing knowledge quickly. I'm Ian Goldie, and today's lesson is one of several videos I created for investing basics. In 5 minutes, my goal is to quickly educate you and then offer an extended version for those wanting more knowledge on our subject. So check out my trailer for more info on me, but briefly, for 25 years, I've been a professional financial advisor and portfolio manager for some of Wall Street's biggest firms. I have multiple patents, trademarks, started a few companies, plus I love helping people, which is the whole point of these videos, to help empower you, the viewer, with real knowledge so you become financially informed, self-sufficient, and closer to turning your dreams into goals. Let's start the clock for today's Finance in 5 subject, investing for returns. When you invest, you want something in return. For example, some have pledged their time to helping humanity, and they might measure their return on the reduction of disease or educational achievements. Today, though, we are going to think in terms of money and monetary gain. For this video, I will focus on investing for profit, money, moolah, cash, cheese, cake, whatever you want to call it, as long as it equals more than when you started. That is called return. So what is return? Think of return in simple terms of getting back something. How much am I getting back? When will I get it? How will it come back to me? Return has two parts. One is the return of principal, which is the amount of money you put in, what you started with. Part two is the excess of your principal, and that is what is defined as return on investment. For example, say in January of 2000 you purchased a 10-year US government treasury bond. The interest rate was 6%, so $10,000 equals $600 interest each year. At the end of 10 years, you get your $10,000 original investment back or returned, plus you got $6,000 in interest over those 10 years. That is return on investment. Bond knowledge is crucial to being a well-rounded investor. I'm here to help in another 5 in 5 video, Bonds for Beginners. Okay, let's get back to return on investment. In this chart, you see interest rates have been decreasing for 20 years, which is great news for people who want to borrow. And today, that same 10-year US Treasury pays a rate of 0.60%. Before it was paying 6, and now it's paying less than a fraction of 1%. Let's take a look at an example from a return on investment standpoint. If you bought that US 10-year Treasury bond in 2020 and magically it paid 6%, it would take you 12 years to double. Today at 0.60, it will take over 120 years for your money to double. 120 years for your money to double at a rate of 0.60. How do I calculate that? Major quick tip rule of 72. This is the time it takes your money to double. It's a simple math equation. It says any number divided by 72 tells you how long it will take to double. And once you know the rule of 72, you will use it for the rest of your life when making investment decisions. When you end up with more than you started, you have positive return. And sometimes investing can lead to losses, which is negative return. We cover this in risk returns in another video. In some countries right now, their interest rate is less than 0. You heard that right. If you invest in a government bond or money market fund in these countries, you heard me, Germany and Japan, the rate is guaranteed negative and you will end up with less principal than you started. So what kind of upside down world are we living in where your investment is a guaranteed loser for choosing a less risky investment? Look, to become a good investor, you must make decisions. And you must make those decisions with your money or your capital. That's the term we're going to use, capital. In finance, it's not money, it's capital. And you make these decisions based on your expected returns. To conclude our 5-minute overview, remember, when you're allocating capital, you're investing based on the premise of future positive returns. This has been Finance in 5 series Returns. Like and subscribe so we can keep making videos and help people just like you become better investors. Continue watching this video for our extended portion for those wanting to learn more about returns, including some examples of some of the best and worst investing returns of all time. Click on our links to learn more about incredible financial software our company is developing and how you can get free trial access when it goes live. Once again, my name is Ian Goldie. This is Finance in 5. You can learn about me in the trailer, including my interests in gardening, like the hibiscus you see behind me, or first pressing records, or concert programs. You're here to learn more about investing, so you're empowered with smarter money decisions. So let's continue with returns and the importance to investors. Here are some amazing examples of returns on investment had you been, keyword had you been, patient and held for years without selling. Let's take everybody's favorite, Amazon. Amazon stock in 1997, split adjusted, sold for $1.50. In July of 2020, it's about $2,900. For a total return since inception of 192,566%. Monster energy drink was priced at 16 cents in December of 1985. And in July of 2020, it was $70 for a total rate of return of 43,187%. Netflix, well, in May of 2002, was $1.91. And that stock in July of 2020, $479 for a total rate of return of 25,978%. Let's just call it 26,000% rounded up. So what does that mean in real dollars? Okay, $1,000 invested in Amazon 1997 would have turned into $1,925,660. And Monster, they converted your $1,000 into $431,870, while Netflix made you $259,780 richer. But they all pale in comparison by the return had by Robert Simon and Alexander Parrish, who bought a painting, later confirmed to be by the master Leonardo da Vinci, titled Salvator Mundi. They purchased this, not knowing, for $10,000. They were speculating. Well, a few years later, after confirming it was Leonardo, they sold it for $80 million. Wait, that's not it. A few years later, it sold for $450 million. Had they kept it, they would have turned $10,000 into $450 million. Do not care about paying the taxes. Don't calculate that. Did I mention they turned $10,000 into $450 million? And I'm not going to even get into the commissions or all that stuff. It's just ridiculous money. Well, there are some good investments. There are also some awful ones. A medallion taxi stamp allows permission to operate in New York City. Well, that sold for $1 million in 2011, according to Reuters. In July of 2020, they've been selling for about $120,000 to $150,000 for a total loss of about 90%. And this is all part of supply and demand. If you want to learn how supply and demand affect almost every single business decision, check out my video, Supply and Demand for Beginners. The world's first mass retailer and catalog marketer was Sears. They were the Amazon of their day, but now their stock has gone from $151 in April of 2007, well, to July of 2020, it was $4.71 for a negative return of 90%. JCPenney is bankrupt, so the return was 100% negative. Becoming a better stock picker by learning more about consumer and economic moats for beginners. It's part of our series. And one of the earliest examples of bubbles and madness of crowds is the total collapse of the 17th century Dutch tulip craze, where speculators priced a single bulb to equal the value of an entire house. That's right, that flower behind me, hibiscus, imagine as a bulb, could buy a house. This did not end well, with losses of 99.9%. Flowers. Crazy, right? I'd like a Ferrari, a pound of gold, and oh, by the way, that Rembrandt on the wall, yes. And here's my 11 tulip bulbs. Bottom line is humans have always valued different things, and I cover that in the video, What Investors Value Most for Beginners. Understanding valuation is critical. But these are investment winners and losers, and you can cherry pick anything to illustrate good and bad returns. So what about real estate, you say? Okay, let's consider the hardworking person who saves enough money to purchase a real estate property, and they want to rent it, and they want to keep it for 30 years. Well, I've worked for many clients that became multi-million they became multimillionaires in real estate and whose returns were based on a combination of rent, the appreciation of the property, and there's some tax benefits. I cover real estate investing along with other types of equities in another video. It's all part of the same series. But with real estate investing, you don't see the investment of time, and there's potential headaches. For example, calls in the middle of the night for something broken, property taxes, insurance, or the major hassles involved in renting and possibly evicting a tenant. These intangibles can really reduce the rate of return when you consider your time as an investment. The stuff you see and touch, that's called tangible assets. And the invisible stuff, that's called intangible. In the real estate example, we show intangibles as time spent and headaches. But intangibles could also be a trademark or a brand. For many decades, investors did not consider the value of intangibles at all. So Mickey Mouse and the Disney brand were not counted as assets. The physical stuff like revenue from theme parks, cash in the bank, inventory, these were the only things considered when valuing a company. Look, today's world is much different, where the intangibles can sometimes be worth more than the physical items. Return on investment now applies to stuff you can't touch. Take, for example, Uber and Lyft. They don't own the cars used by the drivers, but their name, infrastructure, and methods are worth billions. So returns on investment in these types of companies must be different. If a well-known entrepreneur with a successful past launches a new venture, then investors may want to commit their capital early based on expectations that their long-term returns will be positive. And this type of investing is often found in private equity or venture capital, and the return you expect for something risky, well, it should be speculative, should match. A boring certificate of deposit, a CD for 1 year, recently paid 0.5%. Part of the risk analysis should consider that it's an FDIC insured and considered safe and low risk. Alternatively, investing in a new and unproven venture should have, in my opinion, a target of 20% or more per year. Using the rule of 72 that we covered before, that means you would anticipate your money should double every 3.5 years. But in reality, many aggressive investments fail. So you really need to either get lucky and only pick your winners and have a balanced approach, so you have super winners overcome some of the losers and your average return becomes more worth the effort. I discuss these types of decision processes in Stock Investing for Beginners. It's part of the educational series you're being part of, one of 10. Now we're going to cover some math. And this is where some spin their heads because they equate money with confusing math. Let's simplify things and create some valuable life lessons in finance. Write this down or hit pause because the basics are the rule of 72, which we covered in part A, and we include these: average return, weighted return, and median return. Average return and mean return are the same. They're often confused with median. So let's go through a simple math exercise to show how they work and differ from each other in practical investing terms. To explain average, median, and weighted return, let's turn it over to my partner, Adam Myers, in the studio.
Thanks, Ian. Let me show you how to calculate average, median, and weighted returns and why they're so important to investors. Here we have a hypothetical stock portfolio. There are 9 stocks, each allocated at $5,000 for a total portfolio value of $45,000. Each of these stocks represents 11.11% of the entire portfolio. These fictitious returns, when added together, show 174% gain. Now, if I divide this number by 9, we get an average of 19%. These percentages are sorted from largest to smallest. The middle set out of 9 is the median, which can sometimes be used to determine an approximate average. Now, if we change the value of each stock position but still maintain that $45,000 portfolio value, we can see how the weighting changes. Weighted average determines the relative importance of each stock position. Weighting is probably the number that affects portfolios the most when making allocation decisions. Consider this. If one stock made up 75% of your life savings, how safe would you feel retiring with all your money weighted to this holding? This is why portfolios rebalance. investors reduce risk based on an individual position's respective weight within a portfolio. When you hear the market is up or the market is down, the media is often referring to the S&P 500 index. But this index of 500 US publicly traded companies is not evenly balanced. The top 5 holdings, Microsoft, Apple, Amazon, Facebook, and Google, comprise 21.65% of the index. The other 495 companies make up the remaining 78.35%. Knowing how exchange-traded funds are weighted is important for making informed investments. I hope this helps our viewers better understand average, median, and weighted returns. Back to you, Ian.
Thanks, Adam. Great job explaining average, median, and weighted returns. Returns are what drive humans to being better. We want to improve over time. If you found this video a benefit to your life, I greatly appreciate you sharing with as many people as possible. Like, subscribe, and turn on notifications. There are 10 videos in this course, Basics to Investing, so watch the others and enjoy while you learn. I also have links for financial services I use in my business practice and some custom free templates our companies developed for budgets. It's all below. Click the links. Invest in yourself by helping us create more videos by subscribing, liking, and commenting. Pushing a button is easier than pushing a pile of bricks. So click these buttons today. Thanks. Talk to you soon. Come on, let's do it. Stay, Benzie. Stay, Benzie. Mozzie hug. Mozzie hugs.